So Nicholas Bornos of Capital Link, I'd like to thank you all for joining us today. It's our 16th conference we're hosting here in London, and we are delighted and very thankful to have you with us. I'd like to thank all the sponsors who have been contributing to this conference, as well as the speakers, and above all, you for being here. Without any more delay, I will kindly ask Manu to come and take over the first panel. Emanuele, Ted, John, and Simos, please join me. And again, tremendous thanks. We have, I think, a very good program and a full agenda today. Thank you.
I'm Italian, so they put a timer every time so that I don't go too long. Good morning, everyone. My name is Manu Ravano. I'm co-leading IFCHOR GALBRAITHS, which I'm sure you're now familiar with. Soon to be called IG, essentially. Everybody now starts using IG. I would like to thank very much, first of all, Nicholas, and of course, all his team. They have done a lot of work to set up the stage here. It's a big house. It's going to be filled during the day, but some people had difficulties to wake up this morning. So we'll try to be a wake-up panel and be as punchy and as crispy as possible. So first of all, let me quickly introduce the panel. So we have 4 distinct and very good panelists today. So I'm very thrilled to have this panel on dry bulk. Let's start with the first one on my right, the youngest, much younger than me, same name. He's probably one of the most talented new generation shipping executives. Emanuele D'Amico, who is obviously, as a title I never know, but he's the director of D'Amico Dry. Of course, I know him well, so I don't look at the title, but he's certainly the one leading now the D'Amico Group on dry to the next stage. So pleased to have you here, Emanuele. Then we have, of course, everybody knows him, John Su. Great career in shipping, starting really from almost scratch years ago and building up a fantastic enterprise. So thanks, John, for being here. Now we're going to the experience side of Ted Petrone, obviously a legend since I started. I was hearing the name all the time of Ted Petrone, so happy to have you on the panel today, and hopefully you're going to shed some light on some topics that we have prepared. And then, last and not least, Simos Spyrou is Co-CFO of Starbulk, obviously one of the biggest players out there, so thanks for taking the time and being here, Simos. Good, so we'll go through, as I think I did last time, we'll go through a quick presentation, market presentation. I'm going to keep it really short, and I'm going to hopefully go quite fast pace. I don't think it's just to launch the conversation rather than really doing a market presentation. I'm not an analyst, as I say many times, and luckily I got a team helping me. This is okay, IG, no need to, again, spend some time on it. It's now a big firm with 22 offices, so it's a lot of work to hopefully serve the clients better, and this is what we're striving every day. This is the diversification of the group, which we have worked hard in the last years to achieve. And just a note, we're starting a talent program, which has started last week in Lausanne, which I participated to. This is what we really count on in the years to come, because as you know, the biggest challenge for a broking company is the aging of the broking force, including myself. So we have to work on the next wave. Now, research, these are the 4 people who work between 15 and 17 hours a day to really make sure that we enhance our research services to the clients. I think they have done a great work in the last years to really come up to a very satisfactory level of services. So they've helped me to put these very small deck together. Now, let's start with this one. Essentially, the main message here is that there have been, obviously, the big cycles that are depicted here on the graph. I think the most important things to note are the divergence between capes and the rest of the sizes. I think this is something we're getting used to, and we believe that this can go on for some time. The reasons are really close, I mean, supply demand obviously, but almost more demand driven because of the strong additions to the trade flows that there will be. And obviously, we're not going to get into the detail of it, at least not on my presentation, but maybe later with the panel, is yes, China is troubled. Yes, China has issues, though there is a main factor, which is China is producing a lot of iron ore, which is very low quality. And we believe, and at least our research believes, that in the next years to come, a lot of that iron ore will be substituted with iron ore coming from countries which have very qualitative iron ore. So this is what we believe. So we will see some markets which are very interesting on Capes with some, as you can see, the volatility will remain. Capes have been the most volatile by far. And certainly the other sizes will struggle to cope with that, with that supply demand a little bit more flamboyant on Capes. So this is the take that we have given to this. Now, our research has really analyzed things according to 4 cycles. Interesting to see, and just to give you a glimpse, is the money supply cycle. Our research has studied on a correlation between the 3 months interest rates, the US 3 months interest rates, movements, not level, but movements, and the BDI. And they have found that there is certainly a very close link between regular descending interest rate or regular ascending interest rate and reactions to the BDI. So this is something we're watching carefully. Obviously, as we feel and as we think it could happen, there will be in the next 6 to 12 months a regular descent of the interest rates, which could in turn boost trade finance, commodity trading, and then hopefully the BDI as well. So that's an element of support. If we look at the Chinese steel cycle, and that's really the elephant in the room, is China is going through a big transformation. We think the Chinese steel industry, which is suffering at the moment with low margins, high stocks of iron ore, and less sales of steel, will go through further consolidation. And not only that, but also the iron ore industry in China will go through severe consolidation. That's what we believe. And let me remind you, they have been producing on average 900 million tons of iron ore in China, which is almost less than 20% ferrous content. So that is not sustainable in an environment where a lot of supply of iron ore will come to the market and the prices will go down. So it's very probable that we will find an environment with iron ore prices going well below $100, so probably in the $70 range, $65, $70 range, which is what we had years ago, way before Brumadinho and then pandemic. And that might really push the Chinese to phase out the production of iron ore. And that will hopefully give a strong kicker to the market, because the lot of tons that are going to come from abroad will need Capes, mostly Newcastlemaxes, but also some Kamsarmaxes. That's it. On the supply side, there are a lot of talks lately that we have probably been a little bit too optimistic last year, and we were saying, there's no ordering. There is ordering. There is more than what it seems. And certainly China has been reacting a little bit also on a political agenda to promote more yard space. So that is a little bit worrying, and we need to keep an eye on that, because we believe even though the ordering has been low and is still low, but it could pick up, particularly if we have a market that remains resilient. I talked about that, and here you have a summary of the bull and bear that we like to do, because the market obviously is not so easy to read and to take a very strong stance on either side. There are many elements and many factors in the dry bulk, with fragmentation in the market, fragmentation in the commodities. So this is also something that we like to do. We like to have in front of us the bull flags and the bear flags. So I let you read on that. No point for me to read that, but it's a little bit, it sums up what I've said so far. Other than that, I need to take my phone, not to check my WhatsApp, but I got the questions here. So I think we get a good 32 minutes according to the clock. So I think that's going to be already good to hear from all of you. So let me start with the questions that we have prepared for the panel. So, gentlemen, the first question is, can the supply constraints we have seen so far and the limited order book sustain the market irrespective of the macro situation, i.e. of fragile economies, 2 wars and 1 Cold War? In essence, is this market supply driven, or do you think it's still very reliant on demand? So I don't know who wants to take this first question, which is the hardest one, and then usually the flow goes.
I think we should start with the youngest.
Okay.
With the youngest, yeah, that's
Thank you.
that's very generous. That so let Emanuele start.
Okay, so thanks for the question, Manu. I feel market is, as we all know, shipping is extremely a cyclical business. But recently, and I feel on your presentation it was a bit pointed out, it has been extremely distorted. So the freight is not corresponding to what is the macro. We have been facing an incredible container boom due to COVID. We have had some geopolitical issues, multiple wars, Panama Canal and Red Sea crisis, and still market somehow has been relatively good, very good in the last until 22, and now instead this year market has been actually coming off a bit. So I do tend to think that we are going to face quite a rough market for the next 2 years. Countries still keep on seeking commodity security, but I feel that China, and some of your graphs were showing it, is actually facing a very bad real estate crisis, which is not only with reducing interest rates from the local government, where we can think that China may actually come back to the market. And because China eventually on the shipping is still 50% of our demand, I cannot believe that I am actually quite bearish for the next 2 years. Now, hopefully you guys are a bit more bullish than me, so I'm happy to hear.
Ted.
Yes, I would say I try to, Navios, what we do is we try to play time charter market, short, medium to long, according to where we are in the cycle. So I look at macro trends. All the discovery of natural resources in the world are happening in the Western Hemisphere, whether it's oil or iron ore or bauxite, and all the growth of the demand is in the East. So that's a ton-mile issue, and I'll give you a big example. In the last 20 years, the fleet has tripled from 3 million to 1 billion deadweight. Cargo has only doubled in volume. But what's helped it is ton miles have doubled, more than doubled. And you're seeing the same thing. And I think this is one of the reasons the Capes, the usual ratio between the Capes and the Panamax is about 1.9, I think. Today it's 10,000 versus 27, so it's 2.7. We think, as you do, a lot of people say this ratio can't stand, but I think it's here for a while. This bauxite for the Capes has been a game changer because it's all coming from Guinea. If I said to you 3 years ago that Vale was going to add 100 million tons of iron ore shipping to China, we would have done what the Chinese did and went out and bought a whole bunch of Capes. And that's exactly what's happening. So I think ton miles is an issue. I think IMO regulations have saved us from ourselves. I think the order book would be much bigger. We would have rushed in along with the containers. Containers had to spend money, right? They didn't make money for a decade, and then they made decades worth of money in 2 years. So I think supply and demand issue. I think the overage and the new buildings are about 10%, somewhere around 10%. So I don't see a lot of fleet growth going forward. What bothers me is with China is one, but also if you look at containers and tankers, the rates have gone up and time charter and period, and so has the assets. The problem is the assets in the dry bulk have outstripped the time charter rates. So that has to correct. There has to be a reversion to the mean. So I'm not bullish, but I'm not bearish, so I'm kind of in between.
Thanks, Ted. Anyone else from the panel wants to intervene in this? I.e., is the market supply driven, or will the demand be fundamental in the years to come?
I'm very close to Ted's view. I think that the global geopolitics situation have created some inefficiencies in the market, and as you know, inefficiencies is the name of the game in shipping. So we've seen changes in, in routes. We've seen restrictions. We've seen the issues with, the two canals, Suez and Panama. Panama is getting better now. So all these effects have, in a sense, assisted the market so far. The fact that, I agree with Ted, the supply is going to remain contained during the next few years, and capped together with the fact that, we see that new building prices remain quite high. This will assist to have a healthy order book for the next couple of years, at least. On the demand side, we are all cautious with China. China is a major part of our trade, but we've seen lately signs of Chinese exports, especially on the steel industry, assisting the market and replacing the steel consumption from the domestic real estate consumption. So it really depends on how the steel industry will develop during, and the exports during the following couple of years. So all in all, I'm, closer to Ted. I'm cautiously optimistic, but not too bearish.
Understood. Well, thanks. John, to come to you, because you know China very well, and obviously China, as I said before, is a bit the elephant in the room. We are all talking about, the crisis in the real estate. Obviously now the machinery has picked up in the last years as the main driver for also iron ore and steel. Now, what can we expect? As I said before, if the iron ore, that's what we think, but we don't know if it's going to happen. But if the iron ore goes down in price, then there is a chance that the production, domestic Chinese iron ore production, will be phased out, not totally, but for sure for a certain amount. What do you think? Do you think this is plausible?
Yeah, thank you, Manu. Actually, I'm not knowing China as you guys. Actually, I've been out of China for 24 years when I started studying in Erasmus 24 years ago, actually. Well, I think joking aside, the China's economy and demand is really a big question mark, as everyone knows. I think it's something that is very difficult to predict the future market trend. That's absolutely correct. I think, especially on the demand side. And but on the other hand, if we look back the last few months' time, let's say, a lot of players in dry bulk has been very bearish, even since last year. So that's why some companies lost money, I think. Part of the reason I would say that probably we realized during the course that economy is economy, trade is trade, shipping is shipping. Because sometimes probably the economy or the trade is not that strong as people expected, but on the other hand, the shipping remains strong. I think that's part of the question you asked earlier, that I think that's probably due to geopolitical situation, and especially we are after pandemic COVID period. We are unfortunately entered a wartime market, actually. If we realize that, since more than 2 years now, not only in Russia, Ukraine, but also Middle East is really getting, the tonnage supply side is quite unpredictable. So that's part of the reason I think it makes the shipping market remain firm, especially on dry and of course the other sector as well. And I think back to iron ore things, demand, I think the steel products, as my fellow panelists already mentioned, that I think the steel production that's a major driver at the moment for dry. And certainly there's one thing that I will say that uncertain, maybe because also Chinese economy, one of the booming part is the EV cars. So because they are really, at the moment, the China-made EV cars are really pushing very, very strong. Although they are facing a big tariff punishment at the moment. So this is something I think we need to observe the coming months or years, how it will influence also the steel demand, right?
I just want to say one more thing about shipping.
Yeah.
those people on the outside looking in would always try to put a correlation between demand and pricing. We're volume driven, not price driven. I'll give you a perfect example. After Lehman Brothers collapsed and the world went into economic shock, look at 09 and 10. Dry bulk had very good years because monolithically, China went out and got coal and iron ore, natural resources, and oil, and they filled up because, rightfully so, they calculated that with the low freight and the low commodity cost, they could fill up, and this would be the best price they'd get in the next 5 to 10 years. So it's not always pricing that drives demand.
Thanks for this. I think that is quite useful and helpful from the four of you. I think not so different perspectives, actually, but quite aligned. Now, a question for all of you, because you're all, asset driven and asset players and asset, holders as well. We had some good cycle now, and the prices have really reached levels which, we could not really foresee, or at least which were not totally correlated to the returns. What is your strategy, and why do you think there is such a gap between the asset prices and the returns? This one is a tricky one, so maybe the experience will start first.
That'd be me. Yeah. I think you've had a lot of capes, secondhand capes being bought. I think you're right. I think there's a lot of, I think the information on the ground in China is what we're hearing. I absolutely agree on the iron ore. I mean, look at China. They've imported about 1.1 billion tons of iron ore, 1.2 for the last 4 years. It's been flat. Steel production's been flat, yet the prices keep going up. I do think China is still trying to work out through this real estate issues and the deflation issues by bringing in natural resources. And I think the same thing with iron ore is coal. Their coal quality is not good. I think what they're saying is they're going to leave it in the ground, but they don't tell anybody. So I do think the imports will continue to go. I don't know, 1.3 billion tons of coal go. China's 370, but Southeast Asia, including India, ex-China, is half of that, 750, 800 million. So I'm not that worried about the coal in terms of China, but in terms of people ordering ships, there's not a lot of orders. So if you want to pick up a ship, it's like the housing market in the States when interest rates are high. It's a market that you can't get in. You're just going to have to pay the price to get in. And I think there's a lot of confidence because the overage and the new buildings are about the same level, that there's not going to be any fleet growth. So I think the asset players are seeing not a lot of downside risk. We've done new buildings, but what we've done is every time we have a new building, we're chartering it out. We don't do specs on new buildings. We're very conservative that way. But I think there's a lot of players that are doing that, and I don't think that I think they're mostly right.
Thanks, Ted. I think it's a good perspective. I was curious to hear about, from John, because John really has a lot of experience in working on the asset side and buying and selling. So what is your feeling now about these prices, the chartering prices? It's difficult to make a move for many players that we talk to. So what do you think?
Yeah, thank you, Manu. Indeed, in the last 2 years, we have sold more than 10 dry bulkers, actually. But most of them are quite aged and done, coming off 7-8 years long-term or even 12 years long-term contract. We have used to own those vessels since beginning of Erasmus Group. And but again, this is not a clear sign that we are really bearish for the market. On the other hand, we took over the last new building on the dry bulk last year, September last year, exactly a year ago. As Ted said, I think we also somehow missed out relatively low new building price timing back to 2 years ago, let's say, even during COVID time. We didn't put large dry bulk order, unfortunately. We put only 2 during that time. But on H1, I think we will say not only 2 tiers or 3 tiers market. I think the big disconnection on the value and earnings is more on the relative vantage vessels at the moment. Modern ships, I think, is because it's very much close correlated to new building price, and as we know, the new building price is very difficult to get down, partially because of the yards set. Of course, there are certain cost, everything on the new building price front. On the other hand, because there's no more new building slot, so shipyards, they have no any pressure on marketing their slots for 28, 29 delivery. So that's why I think for a certain period, we will say the modern tonnages on the dry bulk and probably other sectors as well will remain still very firm and high. But on the second relatively vantage vessels, as Ted also said, even though we saw last week, we saw even 18, 20 years old Capesize sold for 20 million plus levels. So that's something that honestly we're not sure whether this is wise or not wise, because again, maybe there's a surprise again in the coming months that any supply chain disruptions may also push up the asset value. So this is something that I think I would say in a very short term, we may say still a very firm asset value remains.
Mm. Is there a feeling from the rest of the panel that the prices of the assets might come off, at least second-hand, might come off? Or do you think that's a possibility? Or do you think that at the end of the day, the expectations and the money that is available in shipping will actually not let it dip?
Manu, I believe that, personally, I feel that asset values have been driven primarily from the new buildings. We've seen a shift in yards, even in Chinese yards, moving to more sophisticated type of assets. So during the previous cycle, most of the Chinese yards have been building dry bulk vessels. Now you see that they're getting more and more into more sophisticated and higher profit projects on tankers, product tankers, containers, whatever. So the slots that they have available for dry bulk are less and less. As John said, if you go out now to build a vessel, the earliest that you can get delivery is for 2028. So this has kept has pushed the new building values up. And this has kept also the second-hand values up. Now, the correlation between the asset values and the chartering, the freight market, as we have seen, has changed. Actually, we have not seen the freight market moving the same direction, or at least to the same pace. But what might be positive is if we continue seeing asset values, and especially on the new building side, at such levels, and with deliveries so far away, 4 or 5 years later, this will contain the order book, and we can still have a very healthy order book for the next 3, 4, 5 years. And given the fact that the existing fleet is aging, and by 2028, the vessels that got into the market back with the previous cycle between 2008, 2012, are going to be, between 15 and 20 years old. You will see gradual, supply reduction, because exactly those vessels are going to be inefficient, unable to compete with the new regulations. So this will assist the freight market as well.
Yeah, thanks for that, and perfect assist to get on to the next question, which is a little bit more related to regulations and obviously Fuel EU Maritime. Despite a very gradual beginning, in Jan 25, we expect though the market to change a little bit further. And I wanted to pick Emanuele's brain a little bit on that and understand how he sees. I know he's someone who studies and takes the time to really analyze things. What is your perspective, and how do you, as an owner, really prepare for not only Fuel EU Maritime, but also how have you prepared for EU ETS, and how do you think the market can change in terms of trading patterns?
So in terms of trading pattern, what we will see most probably is that the most eco ships are going to trade in Europe. And this may not even be that good globally, because in Europe sometimes the voyages are quite short. So we may face the most eco ships trading on shorter routes instead of them trading on the longer routes. So we wish as a group that it will be IMO to come up with a plan which will be global in order to make shipping more efficient. Going on to our fleet, we have been trying B30 on several of our ships. It has been extremely successful. It's a drop-in solution. It's already available. We know what is the cost of this fuel. So I believe that as of now, to talk about ammonia, methanol, where we don't even know what is the cost of the fuel, is actually a bit premature. On top of it, there is also, going forward, another solution that it has been talked a bit time by time, which is the carbon capture. And you know, also that one, it's already used in land. So I don't see why we have to invent something completely new when we can actually apply the carbon capture on board of ships, especially those scrubber fitted. So I feel some on the panel will be very happy. But, you know, I feel the carbon capture eventually can be used relatively quickly and could be eventually the solution. Then we will see a mix. So some ship owners will be going for LNG, some for ammonia, and some for methanol. But eventually, the biofuel on the small engines vessels, so if you take Kamsarmax down, is actually going to be the easiest and quickest solution going forward.
Thanks for this. Any other views? Someone wants to take it up? Maybe Ted?
Yeah,
or?
I think let's defend shipping a little bit to start out. We're 200 times less carbon intense than air if you do the same amount of cargo, same distance. It's a big range. I'm picking midpoints, so you can argue with me later. We're 40 times less carbon, more carbon efficient than than rails, and 10 times less carbon efficient than rail. So, it doesn't mean that we shouldn't pollute, right? We're doing the right thing. The EU is starting off first, and as Emanuele said, they're by themselves, so there's a bit of an issue here until the US comes in. It looks like the US Coast Guard is talking to IMO, they're going to get in line. Hopefully around the world you'll have these issues. But the problem is, we have a low density, low availability fuel that's coming, high uncertainty, right? And we're very concerned about our crew. We have about 3,500 crew on the water at any one time. And I agree with Emanuele. I think there's a combination of LNG, carbon capture, methanol, and biofuels. Why do I say biofuels? Because we watch the airlines in the US, right? They get subsidized by the government every time they lose money. We don't. We're not US based, we're New York Stock Exchange. And what happens is we have the space, because it's low density fuel, that we can put extra tanks. The airlines can't do it, so they have to invest in biofuels. And Emanuele's right. We have long-term deals. We talk to all the oil majors. They're investing heavily in carbon capture. So it's going to be a mixture of new fuels going forward. And I think right now what the EU regulations are trying to do really are only compress the price between the new fuel and today's fuel. I just like to know where that money is going to go. And it goes back into shipping, into green technology. That would be the right thing to do.
Thanks. John? Yeah, please.
If I may also add a bit. Of course, on the EU ETS side, from our own dry fleet, we are not very much impacted on that because most of the ships are fixed long-term charter with our commodity trading charters customers. So, of course, we are yet to say by next year what exactly the EU ETS will bring us with a result or a mess or whatever the solutions. But what I would like to point out that probably at a certain point, we will also say that some resistance from owner side due to EU ETS things to deploy that vessel. Probably, of course, I would not say substandard ships, but those ships, some owners, they may be very hesitant to put or place their ships into Atlantic or European market. So back to the market prospects, I would say that maybe we will say at a certain stage that some market areas may be lack of tonnages due to that. Yeah. So then back to the technology regulation part from Erasmus fleet. Also due to the uncertainties of all the different alternative fuels, we are very much focusing on the relatively smaller size now. So from handy size up to maximum Kamsarmax. to try to avoid making some kind of mistakes. So that's something that's similar, I think, to Manu. Thank you.
Thanks. Yes, Simos, please.
No, the only thing that I would like to add, I fully agree with all the points raised, is that, eventually the cost of compliance has to be lower than the penalties that, owners may have by not complying. If it's the opposite, this will not succeed. So if, all these alternative fuels are going to be more expensive than the penalties that we're going to have from the market, it's going to be impossible. So we need to make sure that there is going to be availability of biofuels, of alternative fuels at a cost which is lower than the penalties that one may have.
About the cost, so I defend the dry bulk now, let's defend the poor dry bulk ship owners. There has to be a paradigm shift of horizontal collaboration with charterers, receivers, suppliers. The cost of the extra fuel, the cost of the new engines has to be spread throughout the supply chain. You're not going to have Navios go take a VLCC new building or a Cape new building at 75 million and then add 10, 15 million for the engine, 20 million, and we're not going to cover the whole cost. So we've joined ABS in a few ventures and Lloyd's Register and trying to collaborate how we're going to get there and how that cost can be spread over the entire industry. And I think the end users, whether it's containers or dry, right, it's the natural resources that become finished products that the containers bring back west. We're all going to have to pay the price for this fuel.
Thanks for this, and maybe a few comments to sum it up, because you had, I would say, there was quite some consensus on this point. If I read the panel right, and which is also an opinion I share, is some new technologies are too far and too uneconomical to really be implemented at the moment, particularly in an environment with high asset prices and returns which are good but not good enough to invest in these technologies. So it's going to be a mixed bag of some maybe easier solutions, maybe less green for the time being, but certainly much greener than before, such as biofuel or retrofits of other energy-saving devices and so on. So which is an opinion I share. I mean, what we struggle as brokers at the moment is to promote green projects because simply the economics are not there. And until something really changes, either the prices of the fuels are known and start to be traded, which means there needs to be an infrastructure, or the charters have decided that green is taking over and for them it's more important than the economics of their own P&L, then I think we're going to be stuck like this for another few years at least. So tend to share what you said. We have a little more than 3 minutes. Obviously, there is a very nice last crunchy question, which I didn't put on the slide, so because I wanted to get your gut feeling. Very difficult one for Ted to start with, and maybe I'll end up with a slide which maybe can recap and conclude the panel afterwards, which was not shown before. But before getting there, obviously tonight we're going to have a nice debate in the States. Everybody's talking about it. Do you feel there will be an influence from who's going to get to the White House to the shipping market, or do you think it's going to be it's not going to be so influential? What is your gut feeling, the four of you? We have a few minutes to let's say share the gut feeling of all of you.
So the American goes first, is that?
Yeah, start first, Ted, please. I mean, it's home.
I think you've seen it certainly on the container issue. It's also happening. I think there's a lot of cargo being pulled forward because there's an issue. If Trump gets elected, there's going to be tariffs. You had the strike, so the containers. I do think that it's going to hurt containers more. But I do think, I think the futures on the dry have it right. I am concerned as an American. Whoever gets elected, it's a problem. It's pick your poison. I'm not sure Harris is going to be any different on tariffs. It seems to me like it's the 1930s, and we're doing trade embargo and with tariffs, and that's not good for world trade. But that slide that you put up just before, you forgot bauxite. I think that's a big deal. I think that's why the capes are higher. And the agro products you had about, I don't know, it was 11, 12%. I love agro products being shipped because they act more than grain, because If you do a voyage calculation for grain and it's 50 days, it's always 60 days, right? You're always stopping, there's always rain. So I love when agro products grow because that 11% really acts like an 18%, certainly for the Panamax and Supramax fleet.
Yeah. Thanks. Simos?
No, I tend to agree. Actually, you can never say that, the outcome of U.S. election cannot affect, the macro situation. So we more or less, waiting to see what the outcome is going to be. Obviously, the geopolitical situation is going to be affected one way or another. If you have all the inefficiencies that we are currently seeing in the market stopping, this will not assist the market. Commodity prices, especially the oil price, may affect as well. I cannot think that there is any way that one way or another who is going to be elected will not have an effect, positive or negative, to the market.
Clear. John, Emanuele?
I think I will echo the same with US companies.
Yeah, exactly. Okay, understood.
No,
you're going to follow Ted on this. Emma?
For me, Manu, what I actually feel is that people are thinking that Harris is safer. But somehow Trump is also a businessman, so he may ask for something in exchange. So maybe we may see more export of grain from the US, and eventually it will be better for dry bulk ship owners. So I think it's really unpredictable. But somehow maybe Trump, being him there, asking for something in exchange could eventually be even positive for the dry.
Very good. So I think that sums up the panel. I would like just to show that last slide if possible. That's a slide, unfortunately, I couldn't show before because it was in a second presentation I sent, which my mistake. And it recoups to a point of Ted on the ton mile. We're obviously monitoring very closely ton mile. That's, I would say, the main element of the last years and the main element to watch in the years to come, irrespective of how fragile sometimes it can look out there. The ton mile is going to really be quite important. When one says that the ton mile is good, it means also the trading is quite efficient. And apart from from the inefficiencies we know of the wars, on the main routes, there are some main routes which keep on trading quite efficiently. But that also means that the ton mile is positive. And we see it relatively positive also for 2025, except on coal, where Indonesia will actually ship probably even more than now, and so that's a short route which probably is going to reduce the ton mile. But generally we're quite positive. There will be some bumps on the road in the next 6 to 10 months, we believe. So, and certainly the smaller sizes will struggle a bit more. But all in all, the next years don't look too bad if the market doesn't get crazy about the supply. So I would like to thank very much the panel. I think thanks for sharing your thoughts, for preparing for this, and much appreciated. It was a nice mix, and next time we'll throw a charter in the panel, so at least I'll play the referee role and see what they have to say. And thank you very much, Nicholas. Thank you, Annie. Thank you, Eleni down there. And Anna, thanks for hosting me as a moderator. Happy to do it, and hopefully it helped a few people to have clear ideas on the future.
And thanks to Nick and his team for doing this.